Many U.S. employers are still confused about whether their business must comply with the Affordable Care Act and, if so, what they need to do and when. Penalties are steep and the clock is ticking. Santa is one of these such employers at Claus Resources in North Pole, Alaska. He reached out to us after reading that, according to the IRS, many employers exposed to ACA penalties don't even see themselves as businesses that need to be in compliance. Well, you need to comply with the Affordable Care Act when you're an applicable large employer, or ALE for short. But how do you determine if you're an applicable large employer? It's a question we hear from many. As an example, we'll use Claus Resources to help you figure out how to zero in on the employee headcount that determines if you're an applicable large employer and therefore have to comply with the ACA. We'll present high-level must-knows and alert you to find points that can easily be overlooked. The main takeaway is that when doing the headcount calculation, no employee's service hours can be missed. Yet there are exclusions that can be taken. We'll point those out and show what a significant difference they can make. Let's get started by looking at an overview of the U.S. operations of Claus Resources, Inc. As you can see, there are 4 different companies. We'll look at what factors into finding the headcount of each operation, then determine whether, on its own, that company is an applicable large employer. We will check to see if these companies meet IRS rules for common control or affiliation, then determine as a group if they classify as an applicable large employer. Is ACA compliance then a must? Keep in mind that as we check each company, we're looking at the workforce of the previous calendar year. That's where we get the numbers for the monthly averages. When counting heads to see how close a company is to an ACA compliance threshold, you can take an exclusion for owners, partners, and shareholders. You will see that this exclusion is taken for one Claus Resources company, but not another. As Shiny Nose Brigade, one of the 3 owners, Rudolph, is their full-time employee all year long. Along with the other reindeer, Rudolph works an average of 30 hours per week during the whole year, delivering gifts to the Niceless and maintaining the sleighs. Because of its stable workforce and predictable schedules, Shiny Nose Brigade makes for a head count that's easy to figure. By adding the 9 full-time employees for every month of the year and dividing by 12, we get back to 9. Because that number isn't even close to 50, the owner exclusion isn't taken. Shiny Nose Brigade is not an applicable large employer. Math for the headcount at Santa's other 3 companies gets a little trickier because they all have part-time employees in addition to their full-time employees. In ACA lingo, part-timers are called variable hour employees. Here, you can see the formula for turning variable hour employees' time into equivalents for full-time. For every month, the number of equivalents is adding to the number of full-time employees and then averaged. Let's see how that works for N-squared solutions. At this company, which provides the intel not only for Santa, but also for the Easter Bunny and the Tooth Fairy, there's a staff of 12 full-time developers. For the previous year, part-time IT teams were called in at 2 different points during the year. With a headcount of 18, N-squared solutions is nowhere near the 50 threshold for being an applicable large employer, so there's no apparent need to take the exclusion for owners. But for a reason that we'll soon see, it was taken after all, to bring the ALE count down to 14. Another exclusion that employers can take for the ALE headcount is for anyone covered on a U.S. Department of Defense plan through the Veterans Administration, or TRICARE. The original bill was called the Hire More Heroes Act. In the case of Santa's 3rd company, hiring because of this ACA change makes for a significant difference in headcount. Rent a Righteous Santa was founded in 2003 by Mrs. Claus, who was concerned that Hollywood's portrayal of a mall Santa and his little helper that year might create unacceptable role modeling for such jobs in years to come. In 2013, when Mrs. Claus read that the Hire More Heroes bill was introduced, she directed administrators to try recruiting veterans and their family members. By 2014, most employees at Rent a Righteous Santa were workers already covered on a Department of Defense health plan. After taking that exclusion, the ALE headcount dropped from 28,788, which clearly would have made the company an applicable large employer, to 34, which keeps the company under the 50 FTE threshold. Seasonal workers are the best known of headcount exclusions that can be taken. The key thing to remember with this exclusion, though, is the definition of seasonal. As you see here, that can only be a period of 120 days or less. At the No Coal for You studio, 3 groups of elves work 3 different schedules at 3 chunks of time during the year. However, only one of these groups fits the seasonal classifications. Those are the Rapper Elves, and although their schedule makes for the only full-time hours, and they do bring the headcount to above the 50 FTE threshold, they're not factored into the ALE headcount because the season they work is shorter than 120 days. So this company too is not an applicable large employer. Now, just because none of these companies met the 50 FTE threshold individually, Santa is not off the hook about ACA compliance to-dos. We must still review whether these operations met IRS rules for being commonly controlled or affiliated. Let's take a quick look. As you can see, this is the quickest of our ACA analysis for Claus resources. Not only are there common owners with Santa and Mrs. Claus, these companies serve one another and together they serve other parties. In this case of these companies, the operations are commonly controlled and affiliated. We need to look at the combined headcount to see if, as a group, they meet the applicable large employer classification. And yes, the total headcount for the U.S. operations of Claus Resources is more than 50. It no longer matters that each of the 4 companies does not on its own classify as an applicable large employer. Because they are related to the point of being considered a group, and the group classifies as an applicable large employer, they are each required to comply with requirements of the Affordable Care Act or face penalties. So, the conclusion here is that unfortunately a company with 50 or fewer FTEs can't just breathe an ACA sigh of relief based on its own numbers. It needs to make sure it is not a commonly controlled or affiliated company. Don't take our word for it, take the word of an IRS tax law specialist, Tim Berger. Quote, if the combined number of full-time and full-time equivalent employees for the group is large enough to meet the ALE definition, then each company in the group, called an applicable large employer member, is considered to be an ALE, even if it separately would not be. If you would like to learn more in a live session that also introduces our cost-effective and quick-to-implement ACA reporting software, please go to this address for a registration link to the webinar. That same link will have plenty more resources for you, such as blog posts that give you a deeper look into our workforce calculations for Santa, a recording about what Santa and you must do as an ALE for ACA compliance, and IRS resources so you can fact-check the guidance we're giving. Thank you for joining us. We hope you found this presentation informative. Please let us know how else we can help you.